There's still concerns that a 2-week sell-off was more than just a correction, and it raised the issue of the future of the equity market. Does it belong to the bull or the bear?
This is no big deal. And we should expect probably more of these short, sharp pullbacks from time to time.
Fundamentals are still supportive. We think and have a really big shift in the volatility regime change would cause for basically a deterioration in economic fundamentals or a shift in macro volatility. And we're just not seeing that from what we got. It was a buying the opportunity.
In a situation where you're having a supply and demand dynamic, it's possible that bond yields are going to go up, stocks are going to go down, and that the economy as a whole is going to slow because we have tremendous uncertainty with regard to policy in Washington.
I think it's a sign that, you know, the days of boom equities are over. And we've now got more risk in there.
That correction is just technical. It's not fundamental. The only way equity market keeps falling is if the growth starts to disappoint, because this is where people are actually complacent. So everybody is bullish on growth and worried about bonds.
Well, we've had our correction. Now it becomes very ambiguous what next, whether this will turn into a bear market or whether it will stabilize and go up.
Well, joining me now is Sonders, Charles Schwab, Chief Investment Strategist. Are you going to use the F word on me, fundamentals?
Well, yeah, but I'm going to give you a but. So
Okay.
The fundamentals are strong. They are supportive. But the but is that there's a number of things that sort of hit inflection points that maybe investors need to be mindful of. Nominal GDP growth is now above the unemployment rate. We've closed the output gap. So these things are good in the sense that they're supportive of equities. However, at some point you get to the data being so good it becomes inflationary, brings on tighter monetary policy, and causes more volatility in the market. So the lack of volatility last year was enough of a reason alone to give you an idea of more volatility this year. Then you have that additional boost we've gotten to growth and even earnings that is a good thing in the near term, but at some point the market starts to look for the inflection point in the other direction.
So what does that do to the equity market? Because if you could argue that passive ETF investing was the world of zero bound and no inflation and no volatility, as we move into the other regime, what is that going to be?
Well, I do think that the playing field has been leveled for active versus passive. And it's not just some of the implosions we've seen in the world of passive vehicles in the last week or two, but also the fact that barring the recent uptick back up, correlations literally crashed. They crashed within the U.S. equity market. They crashed across asset classes globally. So the environment that really supported passive over active, that made even just basic conversations like diversification a difficult pitch to investors, I think that sort of landscape has changed. And I think that is to the benefit of active versus passive. Not exclusively, but that we've always felt that both can sort of live simultaneously within investors' portfolios. It was just a harder sell for active because of, in particular, that correlation problem.